So, let's talk about a multi-trillion-dollar industry you've probably never even heard of. But here's the thing, it affects almost every part of your life. It's called reinsurance, and it is the hidden financial engine that keeps our world from completely falling apart after a disaster.
Okay, think about this for a second. We all get insurance, right? You pay a company to protect your car, your house, your health. But what happens when an entire city gets wiped out by a hurricane? Or a massive earthquake hits a major metropolitan area? I mean, a single insurance company could suddenly be on the hook for billions in claims, all at once. That's enough to bankrupt them. So who's their safety net? Who protects the protectors?
Well, to really get the answer, we have to go back in time. Back to an era of steam and steel and just massive change. The huge problem that insurers face today wasn't dreamed up in some modern boardroom. Nope, it was forged in the fiery heart of the Industrial Revolution. See, before this period, wealth was pretty spread out, you know? It was on countless farms and small towns. But with industry, everything changed. All of a sudden, you had these enormous factories, sprawling cities, and complex supply chains, all cramming unimaginable wealth into tiny geographic areas. The value at risk in just a single city block just skyrocketed. It created a concentration of risk on a scale nobody had ever seen before.
And what's wild is the scale of the response. To even try and cope with this explosion of risk, the insurance industry itself had to just, well, explode. We went from a few hundred companies in the mid-1800s to over 10,000 today. But even with this whole army of insurers, some risks were just way, way too big for any one of them to handle alone. I mean, just imagine the price tag if a deep-sea oil rig collapses, or a billion-dollar satellite launch fails, or an entire fleet of jumbo jets is grounded. A single event like that could create claims big enough to take down even the biggest insurer. In fact, for a lot of these mega risks, something like 90% or even more of the value is passed on from the first insurer. So, where does all that risk actually go?
Well, it flows into a secondary, global market that was designed for this exact purpose. This is that financial safety net we've been talking about.
And there it is, the answer to our opening question, reinsurance. It's a super simple definition for a profoundly important idea. Basically, insurers pay a slice of their premiums to a reinsurer. In exchange, that reinsurer agrees to cover a big chunk of their claims if something bad happens.
This is honestly the best way to picture it. When a massive disaster hits, reinsurance is the shock absorber for the whole financial system. It stops individual insurance companies from collapsing, and that allows the global economy to recover. It's what makes sure money flows back into a disaster-hit area so people can actually rebuild their lives and businesses. It's the safety net for the safety net.
And you know, it's about more than just money. It's what allows a local insurer to say yes to covering a huge new skyscraper. It provides financial stability so one really bad year doesn't just sink the entire company. And crucially, reinsurers are the world's experts in these massive, complex risks. They help the whole industry get ready for everything, from the effects of climate change to massive cyber attacks.
Okay, so how does this risk-sharing thing actually work in practice? It's probably less complicated than you think. There are two main ways they do it.
On the one hand, you've got the proportional approach. This is basically a partnership on every single policy. The insurer and reinsurer decide to share everything, the premiums and the losses, like sharing slices of a pizza. Simple, right? Then you have the non-proportional approach. This is more of a catastrophe-only plan. The regular insurer handles all the day-to-day claims themselves, and the reinsurer only steps in for those really massive, company-changing disasters.
Let's dig into that proportional method for a sec. In the industry, they use this term called lines to describe shares of risk. So in this example, the original insurer decides, okay, we'll keep one line of risk. Let's say that's $1 million. Then they go out and find a reinsurer to take on 10 more lines, or $10 million. Boom. This lets them insure a project worth $11 million, but their own exposure is capped at just $1 million. They basically used reinsurance to multiply their capacity by 11 times. Pretty clever.
Now that other approach, the non-proportional one, they call it excess of loss. This was a total game changer. It was the absolute perfect tool for handling huge catastrophes. An insurer in, say, Florida, could tell their reinsurer, look, we can handle the first $50 million in losses from a hurricane, but anything and everything above that, that's on you. This simple but brilliant idea is what made it possible to insure against the insane financial damage of natural disasters. And this amazing ability to share risk, it wasn't going to stay local for long. It quickly grew into this sophisticated, interconnected global system.
You can really see the progression here on this timeline. It all started with major hubs like Lloyd's of London way back in the late 1800s. Then, fast forward to the 1970s, and you see countries starting to form their own regional pools to keep more of that money and expertise closer to home. And more recently, you've got these incredible stories like India's GIC Re. After the market opened up, it went from being just a domestic player to a global powerhouse. It just shows how dynamic this whole market is.
So today, the whole global reinsurance market is really concentrated in just a handful of key places. You've got the historic Lloyd's of London, of course, but also modern financial centers like Zurich, Singapore, and a few key cities in Germany. These are the spots where the capital, the expertise, and the brokers all come together to trade the world's biggest risks. And to give you a sense of just how concentrated it is, just look at Bermuda. This tiny little island nation is an absolute titan of the industry. It writes a staggering 16% of all reinsurance premiums in the entire world. Why? Well, thanks to a very favorable regulatory and tax environment, it's become a magnet for reinsurance capital, creating this incredibly efficient hub of expertise. But hey, the world of risk, it never ever stands still. The challenges we're facing tomorrow are forcing the industry to constantly innovate.
And this quote right here, it just nails a huge shift that's happening. The old boundaries are dissolving. Reinsurance isn't some closed loop of insurance companies just trading with each other anymore. Instead, it's starting to tap into the massive financial power of global capital markets.
This is where we get to the really cool, cutting-edge stuff. This new frontier is called Alternative Risk Transfer, or ART. The big idea here is to use financial tools, the kind of things you'd find on Wall Street, to package up risk into investments. These are then sold to huge institutional investors, like pension funds or hedge funds, who are always looking for new ways to get a good return.
So what does that actually look like? Well, a great example is a CAT bond, short for catastrophe bond. Investors buy these things, and they get a really high interest rate. But, and it's a big but, if a specific disaster strikes, like a Category 5 hurricane hitting Florida, they can lose their entire investment. It's basically a high-risk, high-reward bet on the weather. Or you have things like risk swaps, where a reinsurer in Japan might trade its earthquake risk with a reinsurer in the Caribbean who's worried about hurricanes. Both companies spread out their risk, making them stronger. These kinds of tools are unlocking trillions of dollars in new capital to help us face the growing risks of the 21st century.
And that brings us to the final, crucial question. The risks we're facing, from climate change to cyber threats to pandemics, they're getting bigger and more complex than anything we've ever seen before. The safety net that protected us yesterday just isn't going to be enough for tomorrow. So the ongoing challenge for this hidden global industry is to keep innovating, to keep designing the financial shock absorbers that will allow all of us to face a much riskier future with at least a little bit of confidence.